Benefactor underwriting for this broadcast has been provided by a grant from Republic Bank. The power of red is back. Major underwriting support for this broadcast has been provided by grants from New York Community Bank, M&T Bank, Perfect Building Maintenance, Customers Bank, Collins Building Services, Marks Paneth. Additional underwriting support has been provided by grants from AmTrust Title, Bank of America, Capital One Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Casamatides Red Apple Group, New Banks, Meridian Capital Group, Ocean First Bank, RPW Group, TD Bank, the One Stop Property Group, and these friends.
So I have a big question. I don't know where we can have different alternative sources of lending for real estate. A week ago, I had a group of 3 individuals talking about, they were all bankers, and they were saying there's money available for real estate. But why do you need to go to alternative lenders? Why do you have to use others if the banks are out there? So today I've assembled this group of distinguished individuals to provide their insight on the market. I have Brad Dubeck, who is the market executive for New York and New Jersey at Bank of America. Ira Zlotowitz, who is the founder and CEO of GPARENCY and also on the board of Eastern Union Funding. And last but not least, Margaret Grossman, who is the managing principal and president of T30 Capital. So you're here because you're a combination banker and you're over insight. Ira is a unique individual who will tell us a little bit about both of his businesses. And Margaret is the alternative lender. For my audience, what is an alternative lender?
An alternative lender comes in where you have a borrower who, for whatever reason, doesn't qualify for or desire traditional financing. Typically it's pricing, and the reason is because their asset either has more risk, is in transition, is really the most common scenario. So you've got a good asset, a good borrower, but they're transitioning the asset and there isn't a stabilized income flowing from the asset. So they need to bridge into that stabilized scenario. And we come in and provide the bridge financing to bridge someone from where the property is today to where it will be after the borrower implements their business plan in, say, typically it's a 2-year period that we would target to transition a property into a stabilized income scenario, at which point they could then refinance into traditional financing.
So here's the question. Tell me what T30 Capital is, okay? How you got into the lending business and what your sweet spot and so on.
Sure. So T30, we are middle market real estate experts. We do debt and equity. So we invest across the capital stack, acquiring assets that we manage ourselves, as well as lending to other operators sort of similarly situated to us. We've typically focused on multifamily. We ourselves have done a lot of value add rehab work on multifamily, New York City, greater New York area. And we've been lending as well for about 7 years to borrowers similar situated to us. And where we think we bring value is in a couple ways. Number one, we're lending in that middle market space that's too small for the Brads of the world to come in and spend the resources to make, say, a $40 million loan. But that's what we know well. We do it. Our team is lean and efficient. We like that size. And it's a little more under the radar for more institutional players. Because we operate on the equity side and we're doing a lot of kind of rehab work ourselves, we feel well positioned to really evaluate a borrower's business plan, look at the execution, value the asset. So we aren't just coming in with a spreadsheet and looking at the metrics on the page. We can really do the holistic 360-degree approach to understanding a deal. And so sometimes there's a hybrid there. We'll look at preferred equity, We'll look at mezz financing. We can do everything across the capital stack in our kind of middle market focus.
So here's a combination question, because you're doing $40 million as your typical. You have clients like the related companies, okay, Silverstein Properties, other people who have gone into the lending and they're in the equity business. How do you, as a banker, look at them of here as opposed to the smaller alternative lender?
Well, look, in our space, and I'll start by saying it's terrific that there's so many different capital sources available to the commercial real estate space, and no one who operates in the space is all things to all people. So we have a very select client model who we cover, and some of the names that you mentioned and many others. We evaluate their real estate equity investments for financing solutions.
But my question really is, do you make a separate loan, okay, like a balance sheet loan to them for their lending business? When you do equity, you do this. For debt, you do that.
Oh, I see your question.
Okay.
No, not typically. The relationships we have are with the equity platforms with those clients, and they raise capital for their lending platforms separately.
But perhaps this could be an avenue for you, because we've seen how well the middle market companies are, and it's just an advantage of that full service banking.
Mm-hmm. Well, I mean, the goal of most of the commercial banks, including ours, is to try to be solution oriented and thinking about our clients' businesses. My wheelhouse is narrowly focused on providing solutions that are more senior level secured financing and treasury and other traditional real estate financing. But it is an interesting observation that those clients who are more venturing into the lending business, have those needs as well.
I'd say a good number of your clients are into the lending business. Mm-hmm. And I don't want to say take away business from you, but I think it's an opportunity that the bank should look at. Now we go to the dark side of the world, okay? Let's talk about what you do at GPARENCY.
So this is why I opened GPARENCY. I wanted to leave the dark side and go onto the bright side. So GPARENCY is to basically, the answer to your initial question when you posed it about what alternate lender. At the end of the day, a borrower needs 100% financing. They have to get 100%. How much of it is, what percent is debt, equity, preferred equity, mezz, and whatnot. And typically, a lender just has one thing called debt. First position mortgage, they'll go up to a certain leverage. How do they gap the difference? So I found that in my former life when I was acting as a broker, where the compensation was based solely on the loan amount, and when I close, then there was so many scenarios where I couldn't provide the right value to a client. By GPARENCY is a subscription-based service. We pay a client pays us a fee, a annual subscription, and we give them all the information. So we start the conversation, we obsess over the GP, and I say, here's your deal. I could say, understanding your deal for you, it's better to go in whatever direction. In many cases, they take the information and go direct. Sometimes they say, do me a favor, can you please do the labor? So when we do charge for a mortgage, we charge based on the time and value put in. So we're able to sit in a meeting, like we're sitting here today, understanding what they're doing, and a couple of hundred other or 1,000 different lending options that are out there. And then some owner says, for this deal, I want this specific story, and I want someone that has experience. They own their own multifamily, so they know what I'm going through.
But isn't that really, in a way, the brokerage business that
it is
you were doing before?
It is the brokerage business, exactly brokerage business, priced differently. So now the brokerage business is more aligned with the interest of the borrower. So I'm acting as the broker, but instead of charging that owner a percent of the loan amount, I'm charging for the knowledge is a subscription. You want time, pay for time like you pay an attorney. So I could fit 80% don't use brokers, they go direct. Someone from college, they're going to go to a broker to come to you, but at the same time they want to see other alternatives. So we are the same premier broker, but we're priced differently, and that affords us to have our motives aligned more with the lender. We're not a thorn to anyone's side anymore. The only people we're thorn to is a broker that wants to charge for that $40 million transaction a $400,000 fee. We charge the same. If we introduce you, there's no added fee to it. You want us to shop it ourselves? Pay us for the time it takes to shop it, just like you pay an attorney.
So how do you get paid for shopping it?
So we get paid. Our fee structure is it's a membership like Costco. Give me a membership to Kim, and it's $5,000 a year, and we'll give you all the intel you need. You want us to actually do the shopping between the lenders? It's $4,000, irrelevant to how many lenders we go to, shop it out, negotiate the term sheet.
So I got $5,000 as my annual fee,
right?
Okay, and then the $4,000
per deal if you want it. someone calls me up, they say, Ira, what should I do for this deal? I'll give you a list of the lenders to go to. I'll make an email introduction as part of your membership. The guy goes, do me a favor, I don't want to deal with it. Just $4,000. Could you please shop it to them, underwrite it, create the competition, bring me back my best offers? That's $4,000. You want me to run it to the close, do all the paperwork? That's another $7,000. So in total, the max you could pay is $16,000. Someone says, I want the full service. I want a full service like a regular broker, $16,000 for the first transaction. $5,000 plus 4 plus 7.
Now, but you say this $5,000 is paid by the client, but also in certain cases the banks pay you.
No, the lender never pays for as a marketplace. There are lenders who call us up and say, there's some deals you're not sending us. You have a lot of clients. You have hundreds of deals that are open at any given moment. Could we have access to your database? We want you to introduce us the other way. We have lenders who call us up and say, Ira, you know this owner? We'll pay you the introduction. The membership fee is like a marketplace. So lenders could pay for it and a borrower could pay for it. But there's no obligation either side to pay. There's no obligation for a lender to, if we have a lender calls us up, say, I'm not paying you any money. It doesn't affect what deals we send them. Our fiduciary is representing the GP's best interest. If a lender's paying, we have a lender pays us to have access to data of what the competitive landscape looks like in the market. We have a lender calls us, Ira, quoting deals all day. What quotes are you giving out in this subset of the market? That's what they get in their membership. It's the data points that they get there. But for the deal itself, there's no back-end fees, there's no side spreads that are in there, and no thorn on the side. So most of the people actually use us for the 5,000, and on some of the deals they use us for the 4. Barely anyone uses us for the 7.
Let's bring out a different alternative lender, the Fannie and Freddie type of lender. They take you out of loans. Explain that for my audience, what a Fannie and Freddie lender does and the U.S. lender.
Simply said, from my perspective, we provide, in many cases, in the balance sheet lending community, the front-end capital for development or for value-add business plans to be executed. But once they are, the asset is most efficiently refinanced in a longer-term market. And for the residential space, the agencies are a leading choice. So the asset transitions from our balance sheet to, a long-term takeout.
What about your takeouts on the agency? Not on the agency, but you have a 2-year loan. Okay, the asset is repositioned, hopefully doing better in certain markets. Who takes you out now, normally?
If our borrower has succeeded, we would see a sale or we would see a refi into a traditional lender at a lower cost.
Would you see more of a sale or a refi?
We see both. Depends on the borrower's business plan, where they are in the life of the asset. And if our borrower has succeeded less, they'll refi into another bridge loan.
Okay. With regard to the Fannie and Freddie, in your brokerage life, how active was that and how important is it?
They're extremely important. Every multifamily, they only do multifamily.
Yes.
Every multifamily owner's dream is that the loan should qualify for a Fannie Mae loan. The question is how much value add is there? If it's ground up construction, you have no choice, taking a construction loan. If it's a bridge, you're going for bridge. To follow up on the sentiment, if that at the end of the 2 years, they're 80% done, they'll probably find a conventional lender with some recourse at a much lower rate to do it, in effect, for another bridge until, the ultimate bridge is from when you start until you end up at Fannie Mae. If they get it totally done, they hit all their metrics.
So let's talk about what does somebody pay today for a Fannie Mae loan?
So today, just Fannie Mae's pricing is really based, they just come out and they say what they want their profit margin to be. They want approximately 2% is what their profit margin should be. So today the 10-year T-bill as of this morning was 305, so it's approximately, there's definitely cheaper, more expensive pricing to negotiate, but the starting point is 5%. The 10-year T-bill was a year ago 130, they're lending it at 330 at that point. So the dream is that no one else has pricing that cheap. You can't get cheaper than the U.S. government. So the only time they got cheaper was when they gave you actual money. The last, all these loans the last year,
right.
it was free. But short of free, that's the next best. So if someone got locked in for 10 years or 12 years at these types of rates, what came out now is that it has to be a perfect loan, or almost perfect. There's definitely more variation today than there was a few years ago. But today, when they're 5%, what's your best bridge pricing you could go down to if you had to today?
Yeah, probably high 4s over SOFR. So
Right.
you're at 5% all
Right.
in, plus you're going to have some points.
So the flexibility of dealing with her is that she looks at you and says, okay, I'll do it, and she shakes the hand, it's done. Fannie Mae has a whole process.
Right.
So when rates were 3% and she's 6%, okay, what am I going to do? I'll rather go to Fannie. It's starting to come roughly the same pricing. So it's interesting. A lot of the Fannie lenders, their production is down of brand new deals are down because many more lenders could confirm, but how much longer could you be at 6%? Where's your cost of cap? This is what's starting to go through the system.
Yeah.
The Feds keep raising rates. So this is where people argue like they were coming at tech and you need a broker. The truth is you do need a broker. There's no one argue you need a broker who has the knowledge of the whole market. But in the structure we have today, I have a lot more, aside from having a few brokers on the team, I spend a lot on research people that we have a team of 15 people that date all three. There are approximately 3,000 lenders in the country. So to know the appetite of the day, how many loans could you do? There's a limit you could do. Banks have the limits. Private lenders have the limits.
So here's my question for you're a different person. You're the 800-pound gorilla, okay? How do people find out about you and you?
Most of our business, actually, GPARENCY is new, so it's 6 months old. Most of it is through, this started with a blend of LinkedIn and cold calling. But now that as we started closing deals, and we're able to actually put, like, in our industry it's called tombstones. Sounds like a depressing type of thing called tombstones, but nonetheless, that's the industry lingo. As you put out tombstones, people start saying, oh, you did that, you did this, and you only charge this. And that, like, everyone does it. That's what gets us. And I traded New York and the real deal.
Right.
So,
Can't ignore social media.
That's right. Can't ignore that.
So let's talk about you.
Well, we like the good old-fashioned thorn in the side, the expensive broker who, kind of can be a channel for weeding out deals. You want to look for brokers who have an exclusive on a deal and it's not a deal that's getting shopped every which way. But repeat, borrowing. So sponsors who we've had successful execution with who like our process, particularly when it comes to if they're doing rehab and we're funding draws and we're kind of standing alongside them, executing their project. If we haven't gotten in their way and we've been a partner with them, they'll come back and we'll do the next one and we'll do the next one. And so we've seen a lot of growth through that, the repeat business and relationships.
So here's the question. Do you set the rate at commitment when you make a commitment, or do you set the rate at closing?
Well, we set the rate at commitment, but we're seeing more, moving to floating rate so that you're not locked in, just given the volatility where we're in now. You're talking to Ira about what rates are right now. I feel like you've got to ask him again tomorrow,
No, now. Ask again.
Right. Ask the question again. The answer might be different.
And you, Brad? What about rates, locking in rates?
So in our balance sheet business, it's a floating rate
Until closing.
platform. Yeah.
What about people who like to lock in their rates?
Well, we certainly offer, a full spectrum of rate hedging options, swaps, caps, and other things to help mitigate that. And sometimes, the asset needs it, depending on the leverage and its cash flow, and other times you're okay floating. But it's definitely a floating rate platform with those options on top.
What about swaps and hedges?
That's what's getting very expensive today. Because it's simple. Its perception is rates are going up. So while it's going up, you're not going to hedge it. I'm not going to sell a cap to you for so little. But that's to the same token. Some people like us trying to lock in rates as long as possible, as fast as possible. But that's the $1 trillion question. Where's rates, inflation, and rents going? If you have the answers to those questions, we could broadcast them anywhere in the world.
So let's talk about asset classes that you like doing and the ones which are a little more sophisticated, which are difficult to do. Margaret?
We like multifamily, we like mixed use, multi with a retail component. We are doing some selective hospitality, sort of high-end drive-up hospitality has done really well in COVID where people aren't traveling, they're not flying, they're not going international. But we do that in markets where there's limited supply. You can't build another one. So we've got a couple deals in the East End, Long Island that, have really been kind of what we could say COVID winners, but we think there's durability there even as the environment shifts. So we like that. We have not traditionally done office. We certainly won't start now. So I think, the real hot buttons are kind of third rails, right? Office and retail. But industrial's hot. We're looking at some kind of what we call covered land where you've got some kind of, it isn't dirt, but it's not land that's at its highest and best use. Maybe it's a property that right now is a parking garage, but your borrower can take it to something better. But there's income today, something more than entitled dirt, but something that's got, an income present right now. So that's where we're spending our efforts right now.
Are you active in Ira's? He likes the tombstones, even though he doesn't like the term tombstones. Do you believe the tombstones are a good source of social media, or the cost of getting a new customer acquisition cost?
I think you've got to do it all in today's world and kind of have your name out there. But like I said, we acknowledge that, but we like the relationships and the repeat business.
And you believe social media is very important to you.
There's no one who thinks it's not important. She wants to use it to get the first client and hopefully get repeat of that first client, win the client afterward. Everyone's dream is repeat clients. That's the dream of everybody. The question is, when it comes to new clients, it's a mixture of everything you got to do. But I think today that the social media is taking off. Like, look at Trade in New York. It's like, people want to, the real deal. You're following the news and the LinkedIn and I don't know. It's even WhatsApp became much more on the real estate side now. There's all these WhatsApp groups popping up for real estate. They didn't have that a couple of years ago.
Unfortunately, you could be on the internet for 8 hours a day, reading all the social media, reading the articles and everything else to evaluate it. That's why you're saying you have 15 people in the research department where they have the capability to take all of this information and filter it out for good and bad. How long does it take to do a loan from meeting the person to closing on a loan?
We pride ourselves on speed to close, so we could go as quickly from meeting the person to closing. You're looking, the fastest we'll do is 60 to 90 days, but from signed term sheet, when you really press go on the diligence and everything else, we could do anything from 30 to 60 depending on how well we know each other, what the diligence looks like, what the asset is, so we'll move quickly.
And what do you see these days?
I'm seeing the spectrum from a week to, because again,
Won't do that.
Because what's your highest rate? So we have lenders that's the whole point. If someone says, I need to close in a week or faster, we had to close once, close in 3 days, there's some lender there at a certain price will close. Go with some of your clients that own the building next door that became lenders. Then, you have so many stories like that. The lender became someone the last bidder on the equity. Right? They say the Sony building was sold. That's what happened when he bought the Sony building. Who provided the equity? The second bidder said, I was ready to pay whatever price. They made the loan. So, but again, the way she's saying is probably typical. A fast is called 30 days typically, and up to about 90 days. Other extremes are outliers, but that's the beauty of the broker. Just someone out there, put the price point in, leverage and price point.
Your traditional loan, how long does it take?
It's a 30 to 90 day model. I mean, there's certain elements of the diligence that you can't rush, but if you have repeat customers with repeat business, you can certainly move swiftly, but typically everything is within 1 quarter.
What about fees?
What about them?
Do you charge a fee? Do you do it for par? Do you, because I'm going to ask Margaret about fees, I'm going to ask her about fees.
So the balance sheet banking world is really upfront fee and, no prepayment. That's really the model.
No prepayment.
No prepayment. Floating rate, no prepayment. That's the typical balance sheet, lender model. There are, diversions from that, but that's typically what most loans look like.
And Margaret?
It's the same for us. I mean, you see an origination fee. Sometimes, usually, you'll see an exit fee, but not a prepay.
But you do have an origination fee?
Yeah.
Okay, and that can be 1% to 2%?
Usually 2% is going to be your total fee. So you probably see 1 point for origination, 1 point for exit is most typical.
And then traditionally, what does the brokerage charge? Not you.
Traditionally, it goes, I tell them it's negotiated to 1%. The 1% is like everyone has a number 1%, but even depending on the loan size, you see that one. What I find the most amazing thing is that just owners don't realize it. It's not like, the big deals they negotiate, the small deals not. It's strength of negotiation. Sometimes you see half a point on small deals, and say if other people pay a point on a big deal, and it's totally reversed. But I think really the fundamental as far as the points is everyone really, it's a game of the points on the inside or outside. It's about a yield spread. You make what you want to make. If someone told you, I'm not paying you any points, so you just in theory, you could price it in.
You price it in?
Yeah, so it's like, that's why that's to a certain extent it becomes a level of a game. But typically a conventional bank is typically no fee up front, and there's prepayment penalty. On a bridge, it's 1 in, 1 out. Or in your case, it's like a lot of them are 1 point in.
Hybrid.
Nothing, and the hybrid.
Mm-hmm.
What about lease property that's land lease? Will you look at that?
We will look at that, yeah. Sometimes it adds complexity around the collateral, what consents come from the owner of the ground. So we like that kind of a thing because we feel like we can bring a little, that's the sort of deal that might have some nuance that a traditional lender is going to shy away from a little more. Although nuance for us usually comes in the form of something operational, something relating to the borrower's execution, but sometimes it looks like that to a legal angle. In New York, there are a lot of ground leases. There's also the regulatory elements. Sometimes we find ourselves lending where there's some sort of regulatory component that a traditional lender doesn't really know how to underwrite in the same way or is unwilling to underwrite in the same way that we will. So you get into those different legal and regulatory nuances.
How do you look at retail today?
We wouldn't do retail standalone given where the market is. Again, there's a lender for everything somewhere. If it's mixed use, we're looking at high quality markets where we think there's a lot of demand drivers that aren't going anywhere.
But what about neighborhood retail? Okay, you go to Queens, certain neighborhoods, you go to Brooklyn, you go to the Midwood section of Brooklyn. These are really established and they're strong neighborhoods. Would you entertain a loan for retail in that type of market?
We wouldn't do probably standalone, but we would underwrite the retail as part of a mixed use project. And, I agree that there's still some fundamentals there that will work,
There's not that many standalone retail in Midwood anymore. Everything's retail at the apartments
Right.
upstairs. It's too expensive to keep it just taxpayer.
So, in conclusion, as Ira said, there's a lender for every type of property. There are alternatives, and if you can get the government with a Fannie and Freddie, it's even better. And the market is there, and there are alternatives. And I'm happy that we brought everybody together. I'd like to thank Brad, Ira, and Margaret. I'll see you next week.
Thank
Thank
you
you very
Michael.
much. Thank you.